We are going to be talking about outlook for Brazil and global context. We are going to have panelists here from the bank. I'd like to call to the stage Mansueto Almeida, head economist for BTG Pactual, Will Landers, head of third-party distributions, and Alvaro Frasson, an economist for BTG Pactual. To close our event for today, hi, guys. Thank you very much for the invitation. It's a great pleasure to be with Will Landers, Mansueto Almeida, to talk about the scenario. I think it's advisable for us to start with global and then we'll come back to Brazil, particularly on a ACOMPANHE meeting day. But the inflation topic is still persisting abroad, and the inflation nuclei also the centers for inflation. After pandemic, the centers have stopped at 3.5–4% in the U.S., much higher than we have seen prior to the pandemic. And everybody starts asking themselves, when will the story converge back to normality, prior pandemic regular things? So do a plot with additional 50 basis being priced to the end of the year. So the question that I wanted to ask you is, what is your view for this global inflation? The expectation is 3.5% for this year. Next year is 3.8, far from this 2% preconized by the Fed. So is that just the post-pandemic inflation, or in the long term we are going to have higher global inflation? Well, good afternoon, everyone. It is a pleasure to be here with you, with Will and Alvaro. I think we're still seeing some of the pandemic effect, and something that we are seeing abroad is that with the interest rate levels from the U.S., when we have it in the model, we see a high chance of recession, but we see the possibility of inflation drop without recession in the U.S., and that's surprising. And something similar is happening in Brazil. Inflation is dropping in an economy that's growing, even though the consumption on investment is very low. Nobody's talking about recession in Brazil. So these are movements that nobody can quite understand, because you have slowing down of the inflation that doesn't really impact the growth. So that probably is connected with structural changes that happened during COVID. Going back to our goal for inflation target for the world at 2%. We don't know how long it's going to be till we see that. The United States has a improved scenario, but in Europe, in the UK, the data for inflation was a lot higher than the expectation of the market. So probably the prime minister will have to be a lot more aggressive. The scenario is still not easy, but we see a slowing down. And the question now is, will it be necessary for the Fed to go up 50 base points to increases of 25 base points each? Or will we require this increase in interest rates? And the market is pointing that perhaps it's not. So it's an uncertain scenario. Some countries like the U.S. are faring better than they were at the beginning of the year. Others, had dropped the rate, and now they are increasing the rate again. So converging into 2%, I believe, is something that could happen, but I don't know if we are going to accomplish this feat in the next 2 years. Do you believe this inflation could stabilize at some point? And with the cut cycles at 24 abroad, could we have a higher for longer or much longer than we were expecting? Well, Good afternoon, everyone, and thank you for staying here with us. It was a long day, very enriching with all the panels. And what we heard is that nobody really knows. What we do know is that the 0% interest rate and 0% inflation, if I had hair, it would be gray. And, we're the only ones who saw that. That's not something that will be the truth anymore. The inflation is going to be 2.5, and I think something that's cool is that we are generally focused here only on Brazil. This was not Bolsonaro's fault or Lula's fault. We went through the pandemic here as everywhere else. We didn't know what was going to happen, if the pandemic was going to leave, when it was going to leave, if it's gone already. So I think it's an interesting thing for us to think about is what is going to happen. And that could be a lot less painful for people than it has been in the past. So I think these are the uncertainties that we are trying to accommodate in the United States and here in Brazil. We don't know if it's going to be higher for longer. We don't know if the interest rates are going to be lowered just to be increased back again. Coupon meetings, Fed meetings, month by month, and then we'll adjust the portfolios. It's also important for you to have active management of the portfolios and a diversified portfolio. In this global diversified portfolio, S&P ends up earning some spots in the heart of investors. Even in spite of the Federal Reserve or this or that, we didn't see S&P going down in any way. So in your equity view, is that a front loader? Because we know that interest rate is going to drop, then let's go for S&P. What are the reasons why S&P is not pricing the opening of the curve in this shorter American interest rates? Well, as it was said here, they said if you had S&P with equal weights and measures for everything, you would see a flat line. So, there's all this diversification, but it's not a diversified portfolio. So this is the reality. Having a diversified portfolio that's well thought out with fixed income, variable income, thinking about what you're going to buy. If you only buy S&P, if the 7 shares don't work, the 7 stocks don't work, then you're not going to work. Mansour, if we think about Brazil, if you can talk about the emerging markets, we talked yesterday, I believe, or the day before yesterday. I get to talk to you every week. It's my privilege, but some global managers have been moving from China to Brazil, and that has helped the growing of the BRL effects. So this movement that we have seen in Brazil in this first 6 months, talking about the market, and then we talk about some macroeconomic topics, but just this rotation of people dropping China and going to Brazil, or is there something here in Brazil that created this risk as well? I think the international scenario improved things for Brazil. I think when the investor decides to invest on an emerging market like Brazil, they compare it to other emerging markets, and that has been favorable to Brazil. We have a lot more certainties in this emergent world. Chile underwent a very complicated year last year, Colombia also. So when you think about Brazil in the emerging market, Brazil and Mexico stand out to the investors for different reasons. Mexico is connected to the near shoring theory because it's so close to the U.S., but we are talking about the problems that we had in the post-election. We are going back to the post-election. The stock exchange is at 120,000 points, which was what it was the beginning of November. So why the interest rate curve opened so much in Brazil? Because after the elections, we provided the wrong messages. The current administration said that if they needed to pick between taxes and Social Security or welfare expenditure, they would privilege welfare. So in the beginning of this administration, they said that they would change the labor reform or the Social Security reform. Someone criticized the independence of the central bank, that it would be best for Brazil to have a higher interest rate. So all of that, pained the market. The stock exchange dropped. The barrier by the end of March, the stock exchange was under 100,000 points. Then, we had an increase in interest rates because of uncertainties brought to the table by the administration. When the government shows that Brazil is not going to be, or when you remove this tail risk, assets improve greatly. We are at an FX rate that is 4.7877, which is much easier to explain than 4.5. We have trade balance surplus records, so it's a lot easier to explain what's happening. Our actual interest rate is much easier to explain than the FX at the beginning of the year. But we are going back to the scenario that should have happened post-election if the current administration would have made it clear since November that they would be very responsible with taxes, with fiscal balance. So we have to improve the market, and we need to work on actual effort. So we have to have signals from the government that they are going to be delivering on the primary results that they promised us to deliver. We are having a wonderful crop harvest. It's the largest food production since 2007. Commodities and the increase in exported volumes is going to lead us to even a bigger surplus. We are going to have a change in the regulatory framework. The country is doing well. What pained us was this uncertainty created by the administration itself. S&P is being positive, so the reforms are not going to be reviewed. So S&P decided to provide a positive bias towards Brazil, or a favorable bias. So S&P, since October or September, October last year, they wanted to change the outlook for Brazil to a positive. And they said if we were sure that regardless of who wins the election in Brazil, the Brazilian reforms approved by Brazil would be maintained, we would change the outlook for Brazil right now. But because we can't be sure, we are going to wait for the next administration and its policies. When they realize that there would be no changes to the regulatory frameworks, Brazilian Central Bank autonomy and other things, they said, the conversations in Brasilia were great because we found a House of Representatives that's going to uphold the changes that were made. The people are trying to provide you with the right message and trying to convince the government, the administration, of the need for reform. As you see, the foreign people, how have they been looking at Brazil? We talked about China and LATAM that helped the pricing, but was there any kind of movement when the curve was around 13.5%? I believe that foreign people looked at that and smiled with their eyes, and that fit Brazil perfectly. Do you think this movement, this international movement, came due to this institutional assessment, as Mansueto just commented, where the House of Representatives was able to provide greater balance between the powers, or they just realized that it was too inexpensive and they needed to increase the price? Well, being something too cheap, it never lasts long. I think people were in a very good mood with Brazil after Lula was reelected. And I think the uncertainties made the market stop. And you see the flows, the international flows into the Brazilian stock market, they were very high up until the inflation. Then they calmed down, then it went down to zero. And if you have a country that's growing 2.5%, which country risk is dropping, and it's dropping greater than you had in the market before. So even for you who are not used to getting more than 1% per month, I think with the interest rates dropping, that's going to help in the pricing in the stock exchange. It's going to help to pique the interest to invest in other assets. And we know these assets are all very correlated. When everything is bad, everything goes really bad. Or when things are good, everything is very good. So you could use all of that to have a better yield. It would help us do a better job helping our clients to have a better yield with lower risks. Yes, even if the commodities are low, which is a different cycle from the traditional that we see in the equity in Brazil. Mansour, bringing you back to the conversation, we have an imminent cycle of interest rate cuts. What industries do you think could make this actual economy more dynamic? Who could benefit from this interest rate cut environment? We see that the GDP forecasts are much better, probably due to the agribusiness, but there is no such offsetting of the base effect. So what do you think that is due to? Well, interest rates at the level they were at was hurting Brazil. Retail and wholesale were both complaining because of the interest rate levels. It's still 13.75, but the expectation of inflation is 5%. So we don't see such a high actual churn. And because this growth is being pulled by grain production, is being headed or led by grain production, we have industries that have been hurt by interest rates that are growing okay. The first quarter was very hard, and the people in the mall were showing me that it was a very good in comparison to the previous year. Some segments, some regulated segments are better protected than others, such as energy transmission and assets that are protected against inflation. Sometimes the leveraging works, sometimes it doesn't. So cosmetic companies, some said that they were not doing very well, but it depends on the company. When you have access to inexpensive capital, with the high interest rates, people will not buy a television or a fridge, but they will spend on beauty products. So it's all this different scenario. What economists were expecting was the Brazilian interest rate to stop dropping at the last half of the year. Now people are saying that it's going to happen in September or perhaps even August. So what is the pace of that drop? 3 months ago, the expectation for inflation, the forecasted inflation was 3.2, but now we're expecting it to be 4.9. The increased taxes over fuel are offset by Petrobras. We'll have an inflation of 4.6, which is within the variation for the Brazilian Central Bank. So perhaps they are not going to be at the center of the metric, but within that range. So Focus research showed an expected drop in inflation for 24, 25, 26, 27. So we are re-anchoring these expectations, and by the end of June, we'll have a new meeting of the Copom, and the expectation in the market is for this goal not to change and be still 3.5%, but we'll have a period of time to bring inflation to the goal, to the objective. So the scenario is all set up so we can have a cut in interest rates, and that's what's going to define Brazilian growth in the next year. This year we are going to grow 2%, headed by agribusiness. Brazilian GDP is frozen in the third or fourth quarter. We are going to have growth. If we have a more accentuated interest rate drop, we are going to have a recovery or valuation in the stock exchange. The interest rate was 250 BPS. So that interest rate drop and the activities showing a little bit more punch, we'll see some reviews, and so all of that will increase valuation. We are facing a scenario now that could be the beginning of a good market moment. We had a good moment in the past couple of months, but the government, the administration needs to play well in terms of their communication. They started criticizing the Brazilian Central Bank and the reforms, but not only Brazil, but Chile and Colombia, they have left-wing governments, leftist governments that don't control Congress, a lot different from what we saw 20 years ago. They used to have much better control of Congress, not the case right now, so that's making the investor feel safer. So we have everything to have a better scenario, but as Will said, there's a lot of uncertainty in terms of inflation and world economy, and it's a great scenario for Brazil, much better than what we had 10 years ago.
Back to what you said about the interest rate cycle, and also what Will said, in the last few reductions in the interest rate, when the central bank started reducing interest rates, the curve was always underestimated, whatever the pace was. Now, if from that point you look 12 months into the future for returns on the stock exchange and the long duration investments, everything turned out better, and the CDI interest rate remained behind. Today, we see that the market is pricing at approximately 450 bips. So that's something like 9.5. What I'd like to understand from you is, do you think that now the market is overestimating things just as it did in the last two cycles? Is there a chance, is there room for us to, by the end of 2024, to have a Selic basic interest rate approximately at 9%? Or do you think that this movement we saw in long duration and small caps products, does that have room to grow in the next few months? Well, Mr. Mansour is the professor here, but I'd like to say something very simple. Early today, we said that Brazil's neutral interest rate is around 4%. And if we are talking about 3.8% inflation. Just combine the two, and you'll get to 7.5 to 8.5%. That's where the central bank should be if things were neutral. If inflation is under control and growth is at like 2%, even if that's no major feat, it could even be bigger, but let's not dream about that. Those 9% are the forecast today. So today we say that it could be 9.5, but maybe a year from now, everyone will expect 9. No one will be surprised if we say 9. So, and depending on how the Fed decides things, we may change things further. I'm not talking about politics. I'm talking about foundations. There is room for the Selic basic interest rate to change, and that includes not trying to force the BRL to do anything it doesn't actually want to do. So that's just the market view today. I wanted to add one more item, Will. Not just talking about the current cycle leading up to 2024, but also how can we allocate, especially considering the long duration assets. And in 2025, we have a change in the Brazilian Central Bank's president. So do you think that that will have any impact on our forecast? Well, that's important. But first, the drop in interest rates is pretty aggressive. It could be bigger or lower. It's going to depend on the inflation outlook. There are many things where we economists got things wrong. I think every economist was wrong about GDP projections, not for 1 or 2 years, but for 4 years in a row. So we economists said, oh, the GDP is going to go down by 6%. It went down 3 in 2020. In 2021, we said, oh, it might grow by 2, 2.5. The most optimistic one said 3, but it grew by 5. Now in 2022, lots of people here in Faria Lima said, oh, it's a shame. Because of the high interest rates, Brazil's GDP is going to drop by 1 or 1.5. Some people said, no, it won't go down. It's going to grow by 0.5, but we grew by 3%. Now we started 2023 saying, oh, it's going to grow by 0.9 or 2. Well, guess what? We were wrong about the GDP for many years in a row. So what should we do? Should we fire everyone and start over? No. We're all very well employed. But the thing is, after so many mistakes, there are some elements of the Brazilian economy that are difficult to model. So 3 months ago, everyone started pulling the inflation up to 24, 25, 26. And then you drill down and ask, oh, why is inflation trending to 4.4 in your model and another is 4? Oh, it's because I'm including political risk. So it was all very subjective. Now, if we truly enter a scenario where the inflation rate is well behaved and trending toward the center of the target, we may have an aggressive drop in interest rates, and that could bring us to a scenario with growth that we couldn't foresee before. We could be caught by surprise by growth around 2 to 3%. It's possible. Now, it's very difficult to model growth in Brazil because the models aren't capturing it. When we talk to the people in major Faria Lima funds and banks, we ask for their growth projections with the same interest rates that I'm working with, but your projected growth is twice what mine is, and they say, I don't really know. You know, I hear this from fund managers who are friends of mine who are traditionally pessimistic. So there is room for surprise, absolutely, but it's whatever the government indicates is very important. We know there are some opportunities for investment in Brazil that are really good. We know we're going to have 2 or 3 auctions for energy transmissions. And I know that many foreign buyers are going to take part in these auctions. So there's a lot of locked-in opportunities that are going to attract a lot of capital. They're on the radar for foreign investors. But if we're looking at a macro investment outlook with more consistent growth in the in all the numbers, we're going to need to rethink what is on the table for approving positive changes in the capitals market. We're starting to see this with the interest rate curve. We didn't see any drop. It's been the same. The short-term interest rates are the same since last September, but the long-term interest rates have dropped. We're seeing a change in private debt. So with the changes that we've been structuring for many months now, they are coming out of the oven, so to speak, with very, very different, much lower interest rates. So in the past, there was 100 billion a year in the capitals market, and now it's 600 billion. That's the average for the past 2 years. And we see some movements coming from the BNDES saying it wants to invest more, but they don't do anything to cause distortion in the Brazilian credit market. On the contrary, the BNDES has a plan to enter the debentures market. You know, this is going to bring more liquidity for the debentures market. That's great. It's going to be positive. So listen, I think the interest rate curve as defined can occur, certainly, but it could also vary a little bit, but it can occur, yes. What we're going to have to do is look closely at the numbers. There's a lot of volatility and a lot of expectations and different forecasts about the inflation rate, and we're going to need to wait and see. And if the government behaves, if the current administration helps us along, we can certainly help the central bank drop interest rates quickly. The worst thing that can happen is the government ask the central bank to drop interest, because when politicians and the administration ask the central bank to cut interest rates, that leads to uncertainty, and it can make the central bank become more conservative. So if the fiscal proof demonstrates that the government will deliver the primary results, this is going to be much more important than what the economists say. Us economists, we direly criticize many targets, many primary targets, because for the administration to deliver what it promised, it's going to need to increase its tax collections by 2% of the GDP. And that's not easy anywhere. But, you know, if we look at this and instead say, oh, this demonstrates that the interest rate will not go up, that makes the people happy, and it could mean a drop in interest rates. It's the goodwill, right, that you had from foreigners after the Brazilian election. It didn't exist given the... Well, anyway, to summarize, things are changing. And the market is buying what other people in the market are offering. Some people in the administration seem to have not heard the message. So actually, we should let the BCB do its job. Let's keep technical economics out of politics. Yeah, exactly. The government itself started the debate about inflation targets. And in conversations with the BCB director said, you know, now that we've begun these debates, there's no way to halt them. So we should change the schedule, sure, but let's not change the targets, because this debate needs to be cut short. It cannot be put on standby. So the government missed the ball on deleveraging, because for a country like Brazil that has a very recent hyperinflation in its memory, that's not good. But Brazil's inflation scenario 3 months ago was 6.2, for next year 4.2, and then 4 and 4. So with the poor inflation scenario, 6.2, 4.2, 4 and 4, this administration would have the lowest mean inflation since the start of the Rio plan in 2005. So even in a quote-unquote poor inflation outlook, we would still be trending toward the lowest mean inflation since 2005. And no administration since 2005 has had inflation that low. Every administration has had higher inflation rates. So things are not bad. Okay? We have some sectors that are very sensitive to interest rates. For instance, the real estate market, the My House, My Life program was reapproved, so that has an impact. Our real estate analysts published a report today demonstrating this. If you focus on high income, great. The middle class is going to have some issues because they're very sensitive to interest rates. Now, if the interest is going to continue, then we will see real estate interest in the single digits again. Brazil doesn't have any energy crises, unlike Europe. We have great ag production, and as we increase the area, planted area, and the next year you do not cut that, just leave it how it is, no growth but also no decrease, and other correct measures, other adequate measures like these will be very positive. Maybe we're being too rough on this administration, don't you think? Well, I don't think so, because they really scared us. Now, it seems that every week they scare us. They pick fights with us. You know, the best week in the market for Brazil since the start of the elections, between late October and early April, the best market week in Brazil was in the first week of April, when we celebrated the first 100 years of the administration, and President Lula said, look, we have to help Minister Haddad to turn this deficit into a superavit, a surplus. And he complimented Minister Haddad, and he actually told Mr. Haddad to not worry too much about the radicals in his party, because in his first and second administrations he had the same issues, and there are some outliers, some radicals in the party, but they tend more toward the center as a party. When President Lula said that, they had the best week in 5 months. But then the next week he traveled to China and started fighting with the U.S., so things went down again. So the government, as long as it sends the right signals in the sense of tax reforms, this has a total power over the economic outlook. And perhaps if the government had sent the right signals since they won, things would have been different. Now we're wondering whether the administration will deliver what was promised. And for the first 5 months, we had a very anxious outlook. Now we are starting to see what I thought would occur right after the election. Well,
we don't have war. We have the possibility of dealing with the United States and China, both sides of the war. So we're in a privileged position. The major trade partner for Brazil is China. The second largest is the U.S. Brazil doesn't take sides on political, geopolitical fights. So if you consider 4 to 5 years ago, competing with Russia and China was a lot more difficult than now. 10 years ago, competing with Turkey was a lot more difficult than it is now. So this emerging world went through many different changes, and we are now under an administration where the investor looks and says, look, Lula was moderate. Why is he so radical right now? And we have an administration which speech is more aggressive, more radical in terms of their speeches than reality. What did they change in Petrobras? Nothing. They changed their price policy, and I confess I didn't quite get it. And the price of the shares went up, and I said, why are you buying Petrobras? I don't know what the new price policy is going to be, but we were expecting something so bad that we're a little bit more cheerful now. So the price for the Petrobras stock is always going up because, in spite of criticizing the high dividend payment, the administration says that dividends should be fair. So if they go towards a more pro-growth agenda, and if the administration gets the concessions right, the rate was 19% of the GDP. This year is dropping to 18% of the GDP. You know, if Brazil only grows public investment 1.5 points of the GDP, is not going to be enough. So we're going to require investments from the private sector. So that's why they are being so careful with the concession agencies. We have had meetings with people at the Ministry of Transportation, and I see that they are trying to get the right model to get private investment. I think with concessions, this administration will go forward. There's a point that you didn't touch on that we should talk about, that is the tax reform. That could be a decompression element. We heard Arthur Lira saying that he wants to approve this project by the half of the year vacation. So there would be discussions that would go directly to discussion to avoid amendments to the bill. So what is the level of ease that we could expect from that becoming true in the Senate and in Congress? Well, next week we are going to get a report. This report will grow a majority in Congress to be able to approve the reform. The hammer at the Congress, this is going to be his major reform. So there is also cooperation with the government. So we are going to have to wait to see the possibility of approval. The hammer probably wants to vote it in Congress by early July. They probably could approve it or vote it in the second half of the year. The income tax reform, that's going to be complicated because they're going to have to increase the tax rates. But the administration is being very careful with traded companies. Their tax burden is already very high, so they are probably going to lower RPJ, or they are going to create some sort of mechanism. They're going to be very careful in this tax reform not to hinder the results of companies that are listed in the stock exchange. And that's a major battle. So, income tax reform will come after. You know, this is just an ordinary bill of law project. It's not going to be so critical. That would be what reform is requiring still a lot of negotiations, but perhaps they will be able to approve some things. One of the big Brazil costs that we still see now that we might get lowered after the labor law, the social security law, and the tax reform law, we are going to perhaps be able to decrease this Brazil cost and get this growth from 2.5 to something above that. And this is being digested little by little. It's going to take a while. Once it is passed, that bill is going to be a consensus, and it should be as impactful as social security for all the entrepreneurs here, for all your clients. This is going to be a very important thing. Well, we have 5 minutes to end our panel. First Will, then Mansour. Final messages, expectations for the next half of the year. What are you optimistic about? I'd like to summarize the day, what we heard from our managers today. that came here to spend some time with us is that we have an expectation of improvement. We came to one of the highest interest rates of the majority of the markets that will make the markets feel safer. I think the recession risk is different from country to country, region to region. It's not as high a risk as it was once in the past. Lots of very attractive assets. I believe that this vision where interest rates are going to go down, but we are not going to go back to where we were before. It's very important for those of you who have a portfolio to think about a diversified portfolio and to work with people who could help you with this diversification. Not, betting on what we always have, like the local bias that we see here in Brazil. Probably is one of the countries that has the biggest bias. And it's probably due to where the interest rates are, but count on us to help in this path a long time. I'd like to thank you all for being here, and I'd like to remind you that our MC is turning 50 today. We're here to help you. Well, my main message is I believe the hard times have come and gone. Our inflation is expected to be 4.9, not different from the rest of the world. It's not our highest inflation. We are in a very high inflation world scenario. We are improving. Brazil has stood out in the reform agenda. We are going to have free power in the free market and expensive power in the private market. We expect major growth in power resources. Agribusiness is still growing. We have major boundaries to expand, much different from United States and Europe. We are connected to productivity. We can increase the productivity and increase our arable land. And what I see is that there is some risk for a general strike in Brazil. Zero. The social welfare program tripled in value. It's now a program worth 170 billion reais. So we are a country that suffers from traditional welfare issues, but everything is growing. Our job market is good. Unemployment rates will be between 8 and 9%. We had unemployment rates of above 10 for many months. So we are going to go to a lower rate. We are growing formal employment in Brazil by leaps and bounds. Now that things are getting calmer in the international scenario, perhaps we can look forward a little bit more optimistically. And now we're going to need to be data dependent. I would like to thank you all for being here. Unfortunately, I missed the morning part of the discussion. But whenever we talk about diversifying the portfolio, that's always very important. We always advise our customers, our clients, to look abroad because there are some major investment opportunities. So I think the secret is to diversify. Well, and his team all know that. Our relationship with all of you is extremely important. I think that's it, and let's observe it, but not especially in a hurry. Well, thank you very much, everyone, and see you next time.